Hello, Professor Kiss here. I want to show you how to do a DCF, a discounted cash flow analysis. You will need to do them in most of your cases to value a firm or a project. Now, we did do a DCF in your first corporate finance class, but I want to give you a refresher since it's been a while. So I'm going to share my screen. And first, I'll show you the PowerPoint that I've set up the problem. And then I'm going to share the Excel and work through valuing a firm, in this example, Nike. And then I'm going to also do a sensitivity analysis where I change an assumption. Now, because we're valuing a company, we would not calculate an internal rate of return as we would if we're valuing a project. We're just valuing the company. But I will just remind you how to do an IRR calculation. Okay, let me share my screen and show you what we're going to do. Thank you. So, the DCF method is used to value any company or project that generates cash flows years into the future. The sum of the present value of all the future cash flows will be the total present value of the company or project. If the company or project has a finite life, all you have to do is project the cash flows until the life's end, use a discount rate to calculate their present value, add them to find the total present value of the firm or the project. But if, however, the firm has an indefinite life, like valuing a company, you must also calculate a terminal value in the last year of projections and then discount that terminal value to the present. The terminal value can be found by using a perpetuity formula. This is the growing perpetuity, cash flow sub n in the last year of the projection, multiplied by 1 plus the terminal growth rate, divided by the required return minus the growth rate. That should be a familiar formula for you, how we value a stock that has not constant dividends for a while and eventually constant dividends. Now, this terminal value would be discounted as if it were cash received in the last year of projections. So you can pause the video right now to read the example here. After we do the DCF calculation, we will also do a sensitivity analysis, as you're required to do that for many of your cases. And in my example, I'm just going to change EBIT as a percent of sales, but you could try changing the WACC, the terminal growth rate, or other assumptions as well. So let me go to a new share, and I have the Excel, and I'm going to work through the problem with the Excel. So again, I've repeated the case. And the first thing I need to do is calculate the EBIT. And I said it's going to be a fixed percentage, in this example, 9% of the sales. So I take 9B6, which is where I have my 9%, multiply that by the sales, and that gives me my EBIT for the first year. Now, because I'm going to use that 9% all the time, I will make that a constant by putting a dollar sign in front of the B and after the B. Then what I can do is use the fill handle, that little square here, to drag across and get every single earnings before interest and taxes. Now the tax rate is going to be a constant 24%, so I'll do a similar analysis. So it's going to be 24%, which I have here in cell B13, multiplied by EBIT. And again, I'll make this a constant because I'll be using this throughout. and then I will drag it across. Then my unlevered net income, or my NOPAT, is my incremental earnings after taxes. Notice I am not getting taxes based on earnings before taxes, and that is because with our free cash flow analysis, our DCF, we're trying to value the whole free cash flows that go to all the stakeholders, the debt holders, as well as the shareholders. Consequently, we are not subtracting the interest expense that goes to the shareholders. All right. So how do we get this unlevered net income? We take the EBIT and we subtract the taxes. And again, I will drag this across, same formula here. Next, I'm going to add back depreciation, and because it's a non-cash expense, and I've said that's a constant 400 million or 0.4 billion, since everything here is in billions of dollars, and that's constant. And I'm going to subtract my capital expenditure, which also in my example, I said they're equal, so that is also 400 million. Now, I need to find the change in sales in order to find the increase in net working capital. I'm going to italicize this row because it's not something that is going to be part of my DCF. It's just used to calculate the next line. So this will equal, the change in sales will equal the sales of this year minus the sales of the previous year. And I will bring that across. And now to get my increase in net working capital, I said it is just 10% of the increase in sales. So again, I'm going to use the number I have here multiplied by the change in sales number. And again, I'll make this a constant before I drag it across. Now, how do I get my free cash flow? My free cash flow equals the EBIT minus the taxes, or EBIT times 1 minus the tax rate. And that is my unlevered net income. So I can start with that, row 20. I then add back the depreciation. It's a non-cash expense. And I subtract the capital expenditure, and I subtract the increase in net working capital. So here is my free cash flow for year 1, and I will continue this all the way across. Now, how do I get my free cash flow for the year after the projections? That equals my free cash flow in the last year projections multiplied by 1 plus the terminal growth rate. So that's all I do. I don't actually use that. I'm going to use that number to calculate my terminal value, but I'm going to use the formula that I have here in cell A26. So it equals this free cash flow, the last one I projected, times 1 plus my terminal growth rate, in my example, 4%, divided by my discount rate, which typically is my weighted average cost of capital. So the discount rate I'm using here just also happens to be 10%, not always just in my example. It is minus the growth rate. And now we have our terminal value. So what I'm going to do in row 27 is include the free cash flow, including the terminal value. That's what I'm going to be discounting. So it's going to be rows 26 plus 27. And the only place where there is any entry in row 26 is in G when I've added in the terminal value. So the row to discount is the free cash flow, including the terminal value. Now, what I'm going to do is to use the NPV function to calculate the present value of cash flows beginning in year one. This is known as the enterprise value. And what I'm going to do, I'm going to insert a row here. So to do that, I go over here where I get to insert, and I'm going to insert a sheet row, and I am going to get that. This is the enterprise value. So the enterprise value, we will use the NPV function. Now remember, the NPV function does not calculate the net present value. It calculates the present value of a stream of cash flows beginning in year one. So if you haven't used it recently, type the function you're looking for, in my example, NPV, and press go. And then I'll click OK on the one I want. Now it asks for a rate. In this example, the rate I'm using is my cost of capital. And then it asks for my values, and my values are what I have here in row 27. Notice I do not use the year zero value. If I did, I'd get an error. I make a mistake. What I have here is the present value of the stream of cash flows beginning in year 2021. We're going to receive those. We're not going to receive the cash flow right now. We're valuing it at the end of 2021, looking at all the future cash flows. And you can see now, again, this is all in billions. Now, that's the enterprise value. That goes to all the stakeholders, the shareholders, and the debt holders. Let's look at what belongs to just the equity holders. Well, what I want to do is add any excess cash that I don't need for operations. So that I have up here. So I'm going to add that in. And I'm going to subtract the debt. And that is in my cell B10. So I will now get my equity value. So I'm going to take what is in cell B29, my enterprise value, add the cash, excess cash that belongs to the shareholders, and subtract the debt. That now gives me my equity value, my market capitalization, my price per share times the number of shares. But if I want to find an estimate of my price per share, I'm going to take that equity value and divide that by the number of shares. And everything now here is in billions, number of shares. And I get a stock price of $52.69. Now that's not Nike's stock price. It's just my simple value here. Now I've repeated that over here. Here you get, I've done this. Let's also quickly do a sensitivity analysis. And what I've done is make one change. The change I made here in my sensitivity analysis was to assume that EBIT, instead of being 9% of sales, is 8% of sales. And you can see I have that here in row 18. And with that, I now have a lower stock price of only $47 a share. Let's look at a couple of other examples. And again, I'm not going to go through the whole calculation for you in the interest in time. You can try it on your own. But here, if EBIT is 6% of sales, we get a price of $35.61. And if EBIT is 7% of sales, I get a price of $41.30. So now I've set up a little table here showing sensitivity analysis, showing how stock prices change when EBIT as a percent of sales changes. As I said, you would probably want to also check that with a WACC. Now, what if I want to calculate an internal rate of return? And of course, we do not find an internal rate of return. We do that for a project. So I'm just going to show you as a reminder how to calculate internal rate of return. So what I'm going to do is just show you that over here in my example. So I'm going to just say, I want to calculate IRR, internal rate of return, use all cash flows, including a year zero cash flow, which we may assume, it may be, it may not be, may assume is the cost of the project. You don't find an IRR for a company. Sometimes in some of the projects, there may be cash outflows in more than year zero, but let's just take the numbers and I'm going to take the numbers that I have here in row 27, and I'm going to just take these numbers, ones I have all in billions, and I am going to now add a year zero number to it. So I'm going to assume, suppose that you pay 20 billion to buy Nike, the whole company. Of course, we're not doing that, but I'm just going to do that just to put in a number to use the IRR function. So we go to function and we go to IRR, and I've done it recently, so it's right there. And now we put in all the values. Now, before I do that, and I'm going to get an error how I have it, but I will do that here, and it's going to complain because I have to have this as a minus. You see, it gave me an error message. Now, let's put this in with a minus sign, like as if we paid 20 billion to buy Nike. And now you see it's telling me my internal rate of return is 14%. I was expecting something above my cost of capital. Note also that it is showing it as a whole decimal. If I want to have more decimal places, I can increase the percentage. Okay, so now let me just go back to let's do a new share for a minute. Go back to the PowerPoint and just say that I've also shown you how to calculate an internal rate of return. And now let me stop sharing. So what we have done is show you how to calculate a DCF using Excel. And this is just a refresher since you've done this previously. You will be using the DCF model in many of your cases. Remember that if asked, you should do a sensitivity analysis in case if they don't ask, and we tell you specifically don't do it, you won't do it. If we're just valuing a capital structure problem, you may not be doing you may be asked different things in your cases. But if it's a valuation, as many of your cases are, you will need to calculate a DCF. There, of course, are other methods we will use to value a firm in cases such as comparable multiples, comparable precedent transactions. But the DCF is the model that we're going to be asking you to do a lot. So if you have any questions, please feel free to ask me in class, an email, or any of your other professors in the corporate finance class. Thank you very much. See you in class.